Inflation, the gradual increase in prices of goods and services over time, has been a persistent concern for societies throughout history. The concept of inflation dates back to ancient Rome, where emperors would debase their currencies by reducing the amount of precious metals in the coins, leading to a rise in prices. However, it was not until the 20th century that inflation became a significant issue for many nations. The economic instability of the two world wars, coupled with a growing demand for goods and services, led to a rise in prices that exceeded the rate of wage growth. This resulted in a significant decrease in the purchasing power of the common man. In the aftermath of World War II, many countries tried to address the problem of inflation through price controls and other government interventions. In some cases, this led to a temporary stabilization of prices, but it also caused shortages of goods and services, as well as black markets and corruption. In the 1970s, inflation reached unprecedented levels in many parts of the world, a phenomenon known as stagflation. This was a period of high inflation and high unemployment, which challenged the economic policies of governments around the world. In response, many countries adopted a strategy known as monetarism, which focused on controlling the money supply to stabilize prices. Despite these efforts, inflation has remained a persistent problem in many parts of the world. The reasons for this are complex and multifaceted, but some factors include the growth of the global economy, the increasing demand for goods and services, and the impact of technological change on the job market. Inflation affects the common man in various ways. It reduces the purchasing power of wages, pensions, and savings, which means people can afford fewer goods and services than they could before. In this video, we'll talk about inflation and the causes of rising prices. Now, what is inflation and how does it affect you? Inflation refers to the rate at which prices of goods and services are increasing. It can affect various expenses, including necessities like housing, food, medical care, and utilities, as well as luxuries like cosmetics, automobiles, and jewelry. Once inflation becomes widespread, it can create a pervasive sense of anxiety among both consumers and businesses, as the expectation of further inflation grows. Inflation can be concerning because basically it diminishes the value of money saved today. As inflation rises, it erodes consumers' purchasing power and can even hinder their ability to save for retirement. For instance, if you earn 5% from your investments in stocks and bonds, but the inflation rate is 3%, your real earnings are only 2%. Imagine you're at a candy store and you want to buy a bag of your favorite sweets. Now let's say that the price of the candy is $1 today. But over time, due to inflation, the price of that same bag of candy may increase to $1.50. Now that might not seem like a big deal, but when you look at the bigger picture, inflation has a real impact on our purchasing power. The same amount of money that used to buy you a bag of candy can no longer do so because of inflation. Now let's take a look at another example, a salary increase. If you're lucky enough to receive a salary increase of 3% in a year, that may seem like a good thing at first, but if inflation during that same year is 4%, then in reality your purchasing power has actually decreased despite the increase in your salary. Inflation affects us all, but it particularly impacts those on fixed incomes such as retirees. Their savings and pensions lose value over time due to inflation, meaning they can afford fewer goods and services than they could before. Another effect of inflation is the rise in interest rates. This can impact everything from mortgages to credit card debt. As interest rates rise, borrowing becomes more expensive, making it more difficult for people to afford to buy homes or make big purchases. Inflation can also have ripple effects on the wider economy. For example, businesses may have to increase their prices to keep up with rising costs, which can lead to a decrease in consumer spending and slower economic growth. If all of these are the effects of inflation, what are the causes of rising prices? Number 1, increase in demand and decrease in supply. Now imagine you're in a small town and there's only one bakery that sells your favorite cupcakes. Now let's say that suddenly everyone in the town starts craving these cupcakes and there's a huge increase in demand for them. The bakery can't produce enough cupcakes to meet the demand, so what happens? The price of the cupcakes goes up. The bakery can charge more for its product because there are more people willing to buy it, even at a higher price. The same principle applies to the wider economy. When there is an increase in demand for goods or services, the price of those goods and services can increase. This can happen for a variety of reasons, such as a rise in population, an increase in income, or a change in consumer preferences. For example, let's say that there's an increase in the demand for housing. More people are looking to buy homes, but there aren't enough houses available for everyone. As a result, the price of the homes can increase because people are willing to pay more to get the home they want. Now, you might be wondering, why can't companies just produce more of the product to meet the demand and keep the price stable? Well, it's not always that simple. Producing more of a product can be expensive, and companies may not have the resources to do so. Also, if there is a limited supply of raw materials needed to produce the product, the price of those materials can increase, leading to an increase in the price of the final product. Government policies. The second major cause of inflation is government policies, such as taxes or tariffs, which can impact prices. One way that government policies can cause inflation is through excessive money printing. When a government prints more money than the economy can support, it can lead to an oversupply of the money, causing its value to decrease. This in turn can lead to a rise in prices as people need more money to buy the same goods and services. Another way that government policies can impact inflation is through their taxation policies. Taxes can increase the cost of production, which can lead to an increase in prices. Additionally, taxes can reduce disposable income, which can decrease consumer demand for goods and services. Government policies can also impact inflation through their regulations. Regulations can increase the cost of production, which can lead to an increase in prices. For example, environmental regulations may require companies to invest in expensive equipment or technologies to reduce their carbon footprint, increasing their production cost, and ultimately causing an increase in prices. Lastly, government policies can cause inflation through monetary policies. Central banks can influence the money supply by changing the interest rates or engaging in quantitative easing. If the central bank lowers interest rates or engages in quantitative easing, it can increase the money supply, causing inflation. Exchange rates and inflation expectations. Another cause of rising costs is exchange rates and inflation expectations. When the value of a country's currency decreases, it can cause the prices of imported goods to increase. For example, let's say that a country imports a lot of goods from another country, and the value of its currency decreases relative to that country's currency. Inflation expectations, on the other hand, refer to the beliefs of consumers and businesses about future inflation. If consumers and businesses believe that inflation is going to increase in the future, they may start to increase their prices in anticipation. This can create a self-fulfilling prophecy where prices actually do increase due to the expectation of inflation. So how do these two factors interact? Well, let's say that there's a decrease in the value of a country's currency, which causes the prices of imported goods to increase. This increase in prices can lead to an increase in inflation expectations, which can cause businesses to increase their prices even further. This can create a cycle where inflation continues to increase. So, as we can see, inflation has a significant impact on our daily lives. It reduces our purchasing power, impacts our investments, and affects the wider economy. The best way to deal with inflation is to be aware of its effects and take steps to protect our financial well-being, such as investing in assets that hold their value over time or seeking out bargains and discounts. I hope this video helped you understand the concept of inflation and how it might affect you. I'll be in the comments section to take any questions. Until next time.